And of course, all this, we see oil prices pushing higher, the geopolitical tensions in the Middle East, Iran specifically, that Dow skidding down more than, as we mentioned, I think it was more than 800 points. So let's get perspective on this now from our next guest, Brian Mulberry, Chief Market Strategist at Zacks Investment Management. Brian, thanks very much for joining us. Another roller coaster day, this time on the down.
Yeah, absolutely. We're getting close to that psychological barrier of $80 per barrel of oil, as you were just talking about. The market's going to be really concerned about that level. If it's sustained at $80 or higher for a long period of time, it just makes the cost of everything go up. That reignites inflation fears. It means that, maybe interest rates don't go lower the way this market has priced in so far this year. So you can see the obvious negative impact that's having in markets right now.
And how long does it have to stay at that $80 before it really becomes an issue? I mean, nobody really wants to, unless you have oil companies, then you want to see it. But for anybody else, how long before it does become a legitimate issue?
Yes, that impact has to last for months, not just weeks. And the obvious, issue that we have right now is a still shooting war that's going on in Iran. While the conflict is going on, we can certainly understand why tensions would be high. It's causing some disruptions in the supply chain. Obviously, the Strait of Hormuz is not seeing the normalized traffic that you would see in terms of oil tankers. It's also disrupting refinery. So while all this is going on, temporarily, we can understand why prices are spiking. It's if it stays there all the way through the summer months that you would have that material impact on the economy going forward.
And it's so early, it's so hard to say, but does it look like it might be leaning that way?
Well, that's the fear of the market right now. There's no way to really tell exactly how long this is going to last, and then how long does it take to normalize all of the supply, right? The bottleneck that's happening at the Strait of Hormuz, the bottleneck that's happening in terms of refining capacity being lowered temporarily during the conflict. There's no way to really tell how long it will take to get all of that back and running to the pre-conflict levels.
I'm just looking, I think we're seeing gold down, silver, other natural resources, silver and copper. Copper's also taking a hit today, some of the copper companies at least.
Yeah, I think we're just kind of seeing, that flight to cash at this moment in time. This is one of those stressful periods when you start to see all assets moving in the same direction at the same time. People are just looking to try and get out of the market any way that they can at this moment. I think that, it'll be a little bit easier to find a floor on a day like today because we have had a bit of a washout earlier. The stress that we saw in some of the software stocks from AI already pushed people into a bit of a risk-off mood as we come into this conflict here today. So I don't know that this is necessarily going to be the catalyst for a huge drawdown, but we do definitely see that risk-off mood in the market right now.
And we're actually seeing some people move back to some of the software companies. We're up this morning. I haven't seen them in the last 5 minutes, and it's like the weather right now, right?
Exactly. It's moment to moment right now. But you're exactly right. We did see the NASDAQ in particular doing better here domestically, where we saw people taking advantage of some mispriced stocks. Those anomalies are going to continue to happen as we start to see volatility continue to increase. And one of the best performing assets out there is the VIX index itself, up almost 54% on a year-to-date basis. So that just simply signals we don't know what we don't know. That means uncertainty causes volatility, and we're going to have to decide how much appetite you have for risk in a moment like this.
All right, Canadian Natural Resources reported revenue and profit that beat estimates. Where can Canada benefit from? We are benefiting a little right now. The stronger U.S. dollar, we're kind of along for the ride with the higher oil prices. But we need some long-term changes if we're going to benefit from this, don't we?
Well, what you're seeing is record production coming from Canadian natural resources, especially on the oil side. Natural gas, they're more or less at capacity for what their infrastructure can handle. So natural gas growth is flat, but still operating at 100% capacity. Oil is up, 13% quarter to quarter, up 15% in terms of production year over year. They're obviously taking advantage of the high commodity prices and well positioned to do so. Again, to your point, the one way that you can hedge against higher energy costs is to be owners of these types of companies.
And how are you looking at, if you're looking to buy right now, how are you looking at buying?
Well, I mean, I would want to be a little bit strategic. Again, this is all about how much risk you feel like you want to have in a market in a moment like this. The floor on oil recently has been between $55 and $60 a barrel. As we approach 80, that would give us a little bit wider trading range, but I think the support is still probably at that $60 a barrel, which still means that companies like Canadian Natural Resources should be profitable. I might want to hedge that by owning more of the refinery stocks, something that would be along the lines of Conoco, Exxon, Phillips, something along those lines to kind of offset the risk in production, and that kind of helps hedge against the commodity price itself. Refiners typically run at 90 to 100% capacity all the time because there's no shortfall in demand for things like diesel, gasoline, and those types of products. So there's different ways that you could go about this, but still manage your risk budget, I think, intelligently.
All right. And going the other way, what are some of the things you're staying away from right now?
Well, the volatility that you're seeing, I think, in some of the technology names is real. And there has to be something sorted out here in terms of which type of AI is going to win. Is software dead? No, I think you're starting to see people come back into some of these large software names because they realize that generative AI isn't going to take over everything, at least not right now. But there are going to be winners and losers. And so for us, it's going to be about cash flow. All of these major investments that have been made to grow the AI infrastructure have to come back to some of these companies, but it has to also do so in a profitable way. For an example, Microsoft spending $200 billion this year just to grow data centers. When do they get that money back? And when they do see it in terms of sales and revenue, is it going to be profitable growth for them? I think investors are right to ask some of those types of questions, and there will be winners and losers in this space as time goes on.
Okay, we'll wrap it up there, Brian, but thanks as always for joining us.
Thank you.
Brian Mulberry is Chief Market Strategist at Zacks Investment Management.